Hey traders, Nick Shaheen here, looking at Tesla. And before I do that, I want to remind you, if you wanted to join me in the chat room, we have a lot of fun and we call the market on a daily basis. Email me at sellspreads@gmail.com. Reach out through social media if it's easier for you, whichever. I respond to everyone promptly. All right, so looking at Tesla. This is a daily chart, meaning every candle is 1 day, and it looks like it was going to zero here, and then boom, a huge short covering rally. At least that's what I think it is. Short covering rally. What is that? 20% in a couple of days. It's hard to just say, okay, the fundamentals changed that much in 2 days. Now, mind you, we had a dip before it, but so the question is, what do we do now? Couple of things jump out just from not touching the chart. It's at a point that used to be support. Remember, the $300 level-ish, give or take, was bulletproof until it wasn't. So that's number one. Number two is a little lower than that. That guy right there. We'll expand a little bit the view to see where it came from and how meaningful it is. Obviously, it was meaningful to a certain point because I haven't updated my chart, and it obviously came into play here again. So what about from here on out? So my history, my lessons learned through time is that anytime you have a pivot point like this one that was resistance and then broke through huge, then tested several times for support, and it held several times under a whole bunch of stories, and then boom, one day everything falls off. It's not likely to be like butter going through it again without another headline. So from here on out, I would have to be smarter at picking my entry points. For a trade, it's probably going to follow the market in general. Today, on a huge update for the market, I'm going to deem it Facebook and President Xi Day from China, it was up 5% on the back of all the updates that it had before that. So in order to see technically if I can discern anything on the shorter time frame, I zoom in maybe to a 2 hour. Okay, so here I can get a little bit more information on this whole thing. So here's what I'm looking at. In general, higher lows, right? Knocking on a roof. And usually if the bulls prevail, they will overshoot higher as well. So the question is this whatever, inverse head and shoulder, cup and handle? Usually it is bullish, and usually it has about the depth of the cup. I subscribe to the fact that before I determine how high they were going to go, okay, so technically speaking, it could be up to here, but before I determine that, I look to the left to see what is up here. So obviously, this is an area of importance. So this is that hard line 300. So they overshoot higher. This would be the next level. I think they'd be tested. The gumption of the bulls would be 340. This is stating the obvious for me, just looking to the left to see what happened before. So what if I go back to a daily chart? What if I go back to a 1 year chart? No, that doesn't do me any good. So 5 year, which would be a weekly chart. Now I'm looking at a longer time frame, and now I'm looking at that same level of 300 that was bulletproof and then not. Now I'm looking at that level where it came from and how meaningful it was. So this level right here is meaningful for the sense that it was a roof for a long time and a floor below it, much like this and that area. Okay, so do we have another? So in spirit, looking at Tesla a little bit longer term, do we have another situation brewing to where we have a consolidation zone that will eventually serve as a leg up into another area that wants to do the same thing? That happened in Facebook over and over and over again. I'm not so sure this is warranted to be as easy here with Tesla, but I do know that this is pivot and hard support, because it's not a line in the sand. It's more like a zone, in my opinion. And on bad days or good days, they overshoot higher and lower. So, but a lot has happened here, and for them to decide that they don't want to be here, a lot needs to happen. Meaning they've consolidated over it, they fought over it a lot, and they're not going to let it go, either bulls or bear. So by nature, it'll be support, just from saying that. All right, so it does have support below it. It does have upside potential from the sub daily level. Let's say if I look at the hourly or 2 or 3 hours, it does look frisky with a neckline, an important neckline. So there is a decision to be made. The easy money recovery is probably done, but if markets in general continue to rally, I subscribe to that thesis that only sentiment is keeping us lower, meaning if you have no headlines, we'll be rising in the market based on the fundamentals. But we've had one headline after another, but here we are today, this week, we've had a lot of them just kind of like get suppressed a little bit. So waiting for the next shoe to drop as far as headlines are concerned. Tesla will go with the flow minus the headlines itself. So it recently had credit downgraded, all of which, and it is important for how it operates because Tesla is not a money maker, it's a money burner. It has let's talk fundamentals. I don't like it fundamentally from the prospect of what it is right now, especially as a car company, but I understand that it's not a car company for now, and therein lies the ambiguity of its upside potential. So you can't kill Tesla, the thesis, with one thing. Oh, it has a recall on cars. And then people will say, well, it's not a car company. It's a solar company. It's a battery company. So it's a SpaceX company, apparently. Elon, it's tied to Elon himself. And recently he's fallen out of favor a little bit with his kooky action. And it's tied a lot to the ability to borrow in order to feed the frenzy that is Tesla. Because without money, it's out of business. And if he can't borrow in a rising rate environment or it becomes too expensive to borrow, some of its plans are going to be nixed, if not to say that it'll be out of business as a production. So recently, car crashes, fires, deaths, whatever, it's all bad news. But that's how you shake a stock out, and that's how you create solid floors, if indeed it deserves to have some. So from a perspective of me selling puts in Tesla, last time I did it, I sold around the $200, 189, 185, I think it was, or maybe 189. I can't remember. It was a weekly put that I sold, and I collected gobs of money, and then it ran, and I never did it again. I usually sell puts in things I don't mind owning. Well, Tesla I do mind owning because I don't have a lot of faith in its long-term prospects. Not to say short it. In fact, if I wanted to go long it, I don't mind buying a debit call spread. So so what is that? So I can buy calls. Let's see here, clone it. Yeah, I can buy calls, which is pretty dangerous because if you looked at the premiums with the high VIX, Tesla premiums are huge because it's a volatile stock and a high ticket price. So it'll be expensive to buy just naked calls. So I can buy a call spread. And that means I will buy the call, say the 310. I'm just making up the numbers here in spirit. $310 call. It would cost a lot of money, but in order to lower my entry cost, I would sell the one above it, say 315 or 320, depends on which where I want to stop the profits. So yes, I'm lowering the entry cost, but I'm also limiting my maximum profit. If I buy the call naked, I'm aggressively long Tesla, and if it rallies, I make a ton of money. The percentage on my money would be a lot higher than buying the stock itself. I'll show you that. 1 second. Okay, let's see here if I can show it to you. All right, here is Tesla options chain just from today's action. I picked up, what did I pick up? May 11th, 31 days on the clock. All right, so Tesla was up 5%. So if you bought it yesterday, you're happy you made 5% on your money. However, if you bought calls, you made a lot more than that. These are the calls, 40%. So it is a moneymaker to go with the options, provided you guess in the right directions. Obviously, buying the stock is different because you're buying an asset that lasts as long as the company lasts, whereas if you buy calls, they last as long as this contract lasts. They have them that expire this week, next week, the week thereafter, and so on. That's the one I picked. So which one do I buy for this? For me, I like time on my side. So what's the advantage of going with time? It's like a lottery ticket. You have multiple drawings this week, next week, the week after, until it expires, right? What's the bad thing? Usually the profits come slower. So if I have a spread that expires this Friday and price blows through it in my favor, I get maximum profits almost right away. Whereas if I had that same spread, same level, but way out in time, I'd make money. I'd be very happy, but it wouldn't be maximum profits because there is still time for things to go wrong against me. And that's the idea of it not pricing right away. Whereas if somebody bought it for this week, there's only 3 days left or 2 days left or a day left, whichever. So time is important. If I'm buying, so what do? I go out in time. Because if I'm buying at the money, it's going to cost me the same to buy it for this week or 6 weeks from now or a month or 3 months from now, because it's at the money. So they're going to charge me about half the width of the spread. So I could pick and choose. I could go with $5 wide spreads. I could go with $2.50. What does that mean? So if I want to be long at, let's say, 320 or 312.5, okay? So I would buy the 312.5 call, but it costs a lot of money. The mark is whatever that number is, which looks probably like 17. If maybe actually more, 27. Regardless, let's go with 27. Then that's every contract is $2,700. That's a lot of money. But I can lower my cost by selling the one above it. Therefore, I'd only spend half the width of the spread, thereby completely eliminating the oh my gosh moment when I get a tick that goes against me. So having a debit call spread would give me a little bit more conviction in, okay, if I have a couple of hours that go against me or a couple of days that go against me, depends on how far out I buy it, I'm not going to freak out. I'm not going to be stopped out, because as fast as the profits come when I'm naked calls long, they go. Why? Because I would look here. So if somebody bought these puts expecting Tesla to fall, they lost a lot of money because they guessed wrong. Okay, so that's the difference of doing naked calls or debit call spread instead. So another way of going long Tesla is by selling risk. So let's say if I did the math and I love Tesla at 250, I could sell Tesla puts at 250 and collect gobs of money for that. And it's basically I'm selling somebody a lottery ticket at 250, meaning somebody says, you know what, I think Tesla is going to 250 by next 31 days. I do the homework, and if I disagree with them, I'll say, sold to you, give me my money. And the money goes into your account, but in return, you commit to buying it at 250 if it goes at or below 250. So what's the advantage there? To them, they bought insurance on Tesla or a lottery ticket. And to you is you collected money right now and you're taking the risk. So if it falls to 250 and it stops right there, you maybe put the stock, and then you end up waking up owning Tesla at a severe 20% discount from current price. And you still keep your premium. So if it doesn't go below how much you collected for it, you're still profitable. So who would buy these puts? Somebody that is into Tesla from say 200, and they want to stop their protected profits below 250. So they would buy a 250 put, meaning they want somebody else on the hook from 250 and they want out. They're willing to take the pain back down from 300 to 250, but not risk the next $50 in profits that they have. So they buy that put. But you do the homework, and if you disagree with the risk, or you say that the risk is minimal, I'm willing to take the risk, but I'll be on the hook for it. So I never sell puts and stuff I don't want to own. I really don't want to own Tesla, so I wouldn't want to sell puts. So what can I do? I can sell a put spread. What does that mean? Exact opposite of what we just did. So if I think that I didn't go down to 250, so we'll go with 287. So the mark is really what the price of that put is, right? So if somebody wants to buy a 287.50 put to protect themselves, they have to pay $14 per contract for the next 30 days. That's a load of money. So for me, I'm not going to sell it naked either, because I don't want to own it at 287.50. So there's a happy medium. So what do? I would sell this and buy that. Not going to do it. This is not a recommendation. I am not in that position. I'm just explaining how a credit put spread reads, okay? So one would sell this and buy that. So the difference in that, 70 cents, is what one would collect for opening such a risk. Meaning, if I do 10 contracts, I collect $700 right now. And if Tesla stays above 287.50, that $700 is mine. So what's on the line? On the line is the fact that I could lose $1.50 for it. But you say, oh my gosh, you're going to risk, $1.80. You risk $1.80 to make 70. That's crazy. Why would you want to do that? Well, it's not as bad as you think. It's 33% yield for a trade that has a better chance of just buying and holding the stock. So it's not that bad. Usually I don't like to look, I don't search for such a high payout, because usually for a high payout, that means that odds of success, this one eyeball is going to be about 60%, which is not my, 60% is so close to 50%. For me, 50% is Vegas. It's a coin flip. That's what defines a coin flip. Hey, what is it going to be? Flip it, the coin, up or down, 50%. For me, I'd like to go a lot lower and collect a lot less premium, say 40 cents. You say, oh my gosh, you're crazy. But then let me again rephrase it. That's about 12, 14, depends. Between 12 and 18% yield is what I look for on $2.51 wide. But I usually have a 90% chance of success, theoretically speaking. So that's what I chase. Boring trades that deliver 20% in 30 days. You tell me where you can deliver that in the market, I'll tell you I'm into the market. So that's how I would look on Tesla. So again, to recap, price action of late, short squeeze covering. Does it have more? Technically, it looks like it has more, or it could have more, but it would need the help of the market in general. Fundamentally, I don't like it, but that's no reason to short it. If I do want to go long it, because I'm optimistic the markets in general, then I would go long it via a debit call spread. Some other people would want to sell a credit put spread or naked puts. Not for me. So if somebody says you need to go long Tesla right now, I would do a debit call spread out in time, most likely to encompass an earnings report. Not because I think they're going to deliver great earnings, because I think people would want to unshort it into the earnings, so it might run up into the earnings, and therefore I would be out of the trade. I book profits often and fast, so especially when it's a questionable stock, keep that in mind. So technically frisky, however, long-term technically at a tough pivotal level. So the bulls, onus is on the bulls to say, you know what, we can recover this and go higher from here. I don't particularly like the company, but that doesn't mean I have to trade it based on what I like. The last trade on it was a long trade. In fact, I haven't shorted in a long time. This is how I trade it, unemotionally. I look at it, I look at the facts, look at the catalyst, look at the environment, and trade it within that environment. If you have any questions on this one, don't hesitate to email me, sellspreads@gmail.com.